It does. Yeah. Keeps on trucking, you know.
Yeah.
Yeah, I enjoy those years. I mean, my boys are in their 30s now, but the grandkids are 8 and 6. But yeah, why don't we get going while I'm introducing myself. You can get your presentation up if you'd like, William. I'd like to thank everybody for joining today. And my name is Jason Selno, the founder of Straightforward Financial Insights, a fractional CFO accounting firm. Three people on the team. One is in locally in greater Milwaukee area. And then I have another partner that's in the Sarasota, Florida area. And we can handle clients both locally and all throughout the country. Um, Today, I think, William, we're talking in mostly like a Q&A format, um, back and forth between yourself and I. And then we're going to finish up with some Q&A, if any, from the audience. But for now, why don't you go ahead and introduce yourself and we'll get rolling.
Yeah, no, Jason, thanks for throwing this together. Excited to see what you do with these events over the course of the next couple of quarters and years. But as you'd outlined today, is kind of balancing business goals and personal wealth. Obviously, with your background on the business side and the CFO side, you'll tackle the business goal side, and then own a financial planning wealth management firm here in Charlotte, North Carolina, where we focus working with business owners on the private wealth management, financial planning, and whatnot, and marrying what is the business with the personal because there is no separation of the two. So one might ask how in the world you and I got together. And it's because I liked the stuff that you were putting out there on LinkedIn and some other things and reached out and connected. So just a kind of constant reminder that LinkedIn is a great resource for all of us, right?
It sure is. Yep. And thanks for the shout out that um, you liked some of the content. Appreciate that.
Yeah, no, absolutely. So you want me to kind of get started leading us through the presentation, Jason, and then we'll kind of go back and forth a little bit as we go through some of these just talking points, maybe.
I think so. That sounds good. Why don't you go ahead
Okay.
and go on? I think your first slide was going to be on the Discover Gate, if I remember correctly.
Yeah.
Yep.
So where we, I mean, so Jason, one of the ways Jason and I met is Jason and I have both gone through a program called CEPA, which is the Certified Exit Planning um, uh, uh, designation, Certified Exit Planning Advisor designation. And, so what we thought is kind of our topics for today would just be to go through a couple of the key components of slides. And this is a fairly early on slide that you think about with the business owner and the journey that they take in what's referred to as the value acceleration and the different gates that they can go through. And from our perspective, when we think about business goals and personal wealth, um, the business owner oftentimes their biggest asset is the business. And so many times when we sit down and talk with business owners, we find out that they don't really have a good idea of what that valuation is today. And so one of the first things that we encourage clients, business owner clients, to do is let's get a legitimate business valuation. The Discovery Gate will tell you to do it annually, and there's some value in that. But you should at least do it regularly to get a clean idea of where it is. It's like anything else, it's tough to know where you're going if you don't know where you are. Um, and and then obviously the other aspect of an exit plan is twofold. You need to know what your business is worth, but you also need to know kind of where you are, personally, just kind of who you are here in the soul and the heart. What your own financial situation is like, and then what the business situation is like. And then once you've kind of conducted your review and looked at your financial, personal, and business attributes, it's easier to start to put together a business plan. So We do the financial by creating retirement projections for our clients, Jason, right? We call it financial independence because not everybody, quote unquote, wants to retire in the more classic sense, but it's kind of like that business valuation. The financial plan or the retirement projection gives clients an idea or a roadmap of where they are, where they're going, and how the business can serve that purpose, right? Either by cash flow distributions, turning it into a better cash flow generating asset, or flipping the script a little bit and making it an exit, right? So now all of a sudden it's not generating 200 or 300 or $1 million a year worth of cash. It generates a lump sum, and now all of a sudden there's a portfolio for them to think about and how to manage it. So that's how we like to walk through. We think that financial independence model with the client that helps set the stage for where does the business fit in that financial independence. We don't want to be in a day to day anymore model is super helpful. On the business side, you tackle that a little bit too, right?
That's correct. Yeah. In fact, I have a client right now that's it's engaging in an official valuation. Think of like IRS audit type level, right? I think, William, we know there's software out there to give business owners pretty good idea of what it's worth. I think of, wealth advisors have access to some platforms that can give a pretty good idea of what the business value is. But when you're dealing with a valuations expert that, does that for a living, they're putting together these things for, a judicial type scenario where perhaps there's a divorce involved, where we've got to have some pretty concrete evidence of what this thing is worth, and that comes at a cost, right? It's probably about $14,000 to get this particular valuation done. But there's other ways to at least figure out where on the map one is, right? With I think Mouse is one that the Exit Planning Institute, you talked about the SEPA designation. I think they have some proprietary valuation numbers that they can give. I think Value Builder is out there. That's another one. But yeah, at the end of the day, right? I mean, I'm working with business owners, and I talk a lot about what, do you want to have options, or do you want to have things dictated to you? And everybody has a different lifestyle choices that they want to have when they're, wanting to step away. And if somebody wants to live off the grid, and go hunting and fishing every day, that's probably a lot less of a price tag than traveling the world. It's one of the
Yeah.
examples that I use. So if we want to find out, how close we are to that goal, whatever it is, we need to have some sort of an idea of where we're at today, and then start defining what that runway looks like, so that we can actually get into the last part of your slide here, which is the decide, gate, keep, or sell.
Yeah.
Just be going back and forth, and doing a lot of planning along the runway, but at least with, knowing where we're at, that gives somebody like me the ability to start projecting out, what do sales revenues need to grow at across this time horizon, so that you have some sort of a realistic, um, likelihood of doing what it is that you want to do once you decide to slow down from the day to day. That makes sense.
No, it does. It again, if we do the work with the client and tell them that they need the business to sell for, $5 to $7 million, and you get the valuation that looks at the business and it's worth 2.5 or $3 million today, well, that business needs to double. And then, they've got to come sit down with you, Jason, and say, Jason, how do I, financially, start to manage the business so that we can grow it, expand it, and do it in a way that continues to be cash flow supportive for me as the owner, but also generates additional wealth because, the plan tells me that I need X, Y, Z, or, dollar sign in order to get to where, my wife and I or my spouse and I want to, either continue living the lifestyle that we've lived, or do it in a different fashion.
Exactly. Yeah. Um, it I look at it as a lot of alignment, right? Like, let's not just wait until the day that you're ready to, say, hey, I'm going to put this thing up for sale and try to market it to figure out whether we're in alignment on that. Because there's a lot to do along the way of, bringing in other people that are in the valuation space, a legal team. I mean, those things take time. So, we could start to align those expectations along the way.
And I always have this image in the back of my head of a cartoon from many moons ago where a guy was sitting in a chair across from obviously a stockbroker because it was a 1980s style cartoon. Um, and, out of his mouth, he's got the words that says, I'll retire on, it's Friday and I'll retire on Monday and I haven't saved a dollar. Here's your chance to become a legend. Right. So, that's not the world you want to be in as a business owner when you're thinking about, how is the business owner going to fund the things that we want to do.
Yeah, exactly. Good stuff. Well, we're
So
um, we're we're close to halfway through here. Yeah. Why don't you go ahead and talk about profit gap, value gap? I think we've touched a little bit on the wealth gap.
yeah, I mean, it's the wealth gap's kind of that mindset, and I kind of teeter tottered in between two different slides, right? Um, if going through that financial planning process and diving into the heart and soul of who the client is and what they're trying to accomplish in life really dictates that they need a $5 million portfolio or a $50 million portfolio, whatever the number is. That helps lay the groundwork because then you can now start to track back and say, okay, well, you need 5 million, or you need 50 million, or you need whatever number it is in between. And you've only got $1 million in a 401k and $500,000 in a brokerage account, and you don't have any rental property or anything else that's income producing. You've got 1.5 million. You need it to be five. You've got a $3.5 million gap there. You need the business to fill that gap. And so that's the wealth gap, really. And it's where the role that we play, and then you take over and help right on the second component of this.
Yep. Yeah, profit gap. I was thinking earlier today, I like to kind of talk in stories and metaphors. My girlfriend likes to do some 5Ks, not a lot of them, and I'm not a big runner, so that's good news for me. But now's the time to start getting in shape, right? I put on a few pounds over the holidays and do a little celebrating towards the end of the year, and you put on a few pounds, and I'm uh, I'm maybe running at I'll just admit it, 14, 15 minutes for a mile, right? I mean, I'm getting up there a little bit, but I start getting myself in a little bit better shape and get myself, drop maybe 15 pounds or thereabouts, and I can do a decent, respectable, mile for a 55-year-old. Um, and that's my way of saying that, you take a look at getting yourself in shape. What are our KPIs or our key performance indicators that are relevant to us and our company and the industry that we're in, and just perform better, right? Um, you can drive a fair amount of money to the bottom line, or your EBITDA, earnings before interest, taxes, depreciation, and amortization, simply by being healthier, without changing a whole lot of what's coming in as far as top line revenues. Of course, adding revenues to your organization can cure a lot of ills, but without focusing on, let's change it up a little bit, right? Like if I'm a smoker and a runner, I probably want to quit smoking as well. That also is going to help me to improve the bottom line. So I think one of the first things to look at is the profit gap, and a big part of that is what's best in class performance. Um, and if we're not measuring ourselves against others, at some point we're going to be putting the business up for sale, and how do I look relative to others in my space. And I think I'm moving on into the value gap here a little bit, and that is, you know, um, what do my processes look like as an organization? Ultimately, can the owner step away from the business, or do they have their hands in many places of the business? And that's something that I think at the end of the day, you're looking to lower the risk or the buyer of the organization, that they can step in and take over seamlessly, as opposed to um, something that's really highly still dependent on those owners. So some of the things that I'll talk about with clients at times is, you know, you want to make sure that you have an actual business and not John and Jane Doe, doing business as an S corp, because the more you're taking that risk away for buyers, the higher that value is, because it's an actual entity. So, anything you want to say on the value gap, William?
Yeah, I mean, just as we kind of think about it, Jason, I mean, from a wealth management perspective, as business owners are trying to figure this stuff out, if they have a current financial planner or they don't have a current financial planner, you don't have to commit to a long-term relationship. You can do a one-time financial planning engagement. A lot of financial planners these days will work on retainer basis for business owners. And then there's the old-fashioned AUM model where clients will, turn over their assets to the wealth manager to manage the assets. In return, they also receive some financial planning advice. So there's a lot of ways for folks to tap into the wealth management space and understand that wealth gap. As you think about like the profit gap and how you work with small business owners, though, what's the like at what point in time does that business owner transition away from just a bookkeeper to a bookkeeper plus Jason, or leave the bookkeeper behind and just bring Jason in and really start to focus in and hone in on some of that profit gap, value gap type conversation?
Yeah, that's a good question. I would say there's a few different thresholds, or like chasms to cross. And for different businesses, it can be at different times. But I think, surpassing the seven figures, getting into the million in annual revenues, there's oftentimes an opportunity for a fractional CFO to come in. I think it really depends on how overloaded that bookkeeper, accounting manager is. Oftentimes I see that person, taking on HR tasks and, kind of managing the office. And it gets to the point where two things happen. Number one, they don't always have, the accounting acumen, so to speak, of really staying on top of things. And, if the company goes through an aggressive growth spurt, sometimes they outrun their cash. Okay, so they haven't really paid attention to how fast payroll is occurring, right, compared to when the receivables are coming in and getting turned into cash. So a million's a good threshold. I think around the 2.5 million range is another one. Some other things happen there. One of them can be maybe they're bringing on employees, and they're surpassing the Affordable Care Act thresholds, where, okay, there was still a cost there to, cover employees to a certain extent, but, once it's codified and you have to abide 100% by, the ACA and so on, typically they don't have a lot of, experience. And uh, as far as with the insurance carrier, they're going to charge them a premium on top of the premium. Um, and oftentimes we see the renewal premiums at a significant double digit increase that second year and third year. And so that just eats into the cash flows of the organization. Really, by the time they're 5 million, that's probably, almost a necessity.
Yeah, that's almost at that point in time, you're almost thinking about bringing on board somebody in a more full time capacity sometimes, right, Jason?
Exactly. Yeah. Now the issue there is, do they really have the economies of scale to handle, bringing
Yeah.
that salary on? So that the catch 22 is, if you really have somebody that knows what they're doing, there's a price tag to that.
Hmm.
Um, and if you don't bring that person on, then eventually, they're going to kind of get overloaded at some point, and you're just kind of kicking the can down the road a little bit. Especially if your goals are to keep scaling up and getting to 15 or 20, 30 million. Um, But let's suppose that the person really did know what they were doing, and you can afford the price tag. The people that I know with that, that are bringing that to the table, if there's not enough of a workload, um, boredom can kind of set in. And I think, people at a certain level like to be challenged. And if there's just not enough work to do, eventually, I think they're probably going to look for another opportunity and not just collect a paycheck. So there's some trade-offs there. Um, yeah. Well, we're down
You
to
know, that
about
makes sense.
8 minutes or so, just so you.
Yeah. Um, so I mean, kind of the classic step that EPI, Exit Planning Institute, talks about is identify, protect, build, harvest, manage, right? And those are your classic steps that we think about with value acceleration with the business process. And I mean, really, you can kind of take this and apply it almost in any aspect of life. Is what I keep coming back around to, right? Identify the problem, protect, make sure it's you've got the things that you need around it, and then once you've got the structure to support what it is that you're doing or what your business is attempting to accomplish, right? So you identify it, you put the structures and whatnot around it, and then that allows you to build on top of that and get to the next level. And then as you get to that next level, you're harvesting out those profits and those gains. And then you get back to the next point where you're managing the business again, right? And then you make the decision, what's the next route that I'm going to take? What am I going to identify as my next, line of business or my next ability to grow and scale? How am I going to make sure I'm protected so that the downside risk is minimized? I'm building, I'm harvesting, so it really is. And again, you can think about this with kids too, and you can think about it with relationships and anything else, right? Identify, protect, build, harvest, manage is a great way to kind of think about this. And certainly the wealth plan is no different, right? I mean, we can identify the goals. We can make sure that the estate plan is in place to protect it, the insurance policies, all of those different things. How are we going to build into the future to get the client to where they want to go? How are we going to harvest outright? How's the business going to generate and throw off that money for the client? And then at the end of the day, how are we going to manage that lifestyle, right? So, and it's such a great way to kind of think about life, business, and a wealth plan here in those stages.
Mhm. Yeah, and one of the things that I see, at least from the small business perspective, when business owners tend to get themselves in, quote unquote trouble, is when they're trying to build before identifying and protecting. And that could be even as much as just, breaking it down to identifying, what kind of a contractual terms have I agreed to? I mean, entrepreneurs, in my view, tend to be on that spectrum that they're willing to take risks, they're willing to go after it. Um, they're really good at what they do or working with people, but the accounting and finance end of it, they've always figured it out. When it becomes dangerous is when they start, wanting to, build in new lines of business or things that are not their core competencies, but um, seem to have really healthy, profit margins in them, but they're quite costly. They involve projects that um, may have assumptions that are a little bit too, short of what expectations are going to be. A lot of times projects can go on longer and consume more cash than people initially think. Some of that homework up front of making sure you're identifying and protecting things within your business. Building is great. Adding on new revenues is awesome, but doing too much too fast can sometimes uh, have more negative net negatives than positives.
The old school ready, fire, aim, right?
A little
Um,
bit, yeah.
yeah. So, Jason, I mean, on that note, like, I mean, when you're talking to clients as a CFO, in a CFO capacity, and they have this idea like, oh, we're about to go do this, right? Like, how do you bring them back to and think about it from um, the cash flow and the business management perspective to make sure that they have the the revenue and the support financially in order to make sure that happens correctly and doesn't get them into this rather than harvesting now all of a sudden we're falling down the stairs rather than going up the stairs and trying to figure out where to raise capital from, or invade the home equity line, or invade the brokerage account, or other things, right?
Yeah, yeah. That's the ultimate challenge. I think you're flushing out here, William, for those in the accounting realm. Is and I say this a fair amount. Accountants have the stereotype for a reason. We're not always that emotionally intelligent as a group of people. But I think that's the time that you need to get out those skills. And in my view, those types of conversations have come up when the owner has more or less kind of maybe backed into the corner a little bit, right? They want to chase after. I can think of one example. A company wasn't doing very well, and it's like, this will save it, that'll save it. So I think identifying when fear is being a motivator and trying to get people to slow down, think things through, um, without telling people no, because first of all, it's their business, it's not mine. And who likes being told no? You know, my, I mean, I think it took me till I was 45 before, I was okay with my dad saying no. I wanted to rebel, uh, you know, most of my life. And, he's gone now, so I wish he was back. But um, yeah, I think to answer the question, but without being pervasive or vague here, is really understanding where the business owners coming from, and addressing sometimes emotional needs. But it starts with, I think, getting people to slow down and just let's think things through. And it's asking more questions than it is, dictating to people what they should or should not do, or this is, just a poor decision, or, what does that look like when we start talking about the cost of capital to do that? And
Yeah.
then breaking it down for them. And it's like, oh, wow, really? The embedded rate of return, embedded interest rate cost in this thing is really that much? Wow. Right. And then they can start to see, because you've helped them walk along a little bit in their shoes and understood maybe some of the pain points that they're feeling along the way. So I think that rapport is worth its weight in gold.
Yeah. Then it goes back to the beginning discovery gate that we talked about. We'll close out real quick. Just understanding what you're worth now, and what you need things to be worth in the future, right? That kind of financial assessment, that personal assessment, and that business assessment of where things stand, and what you need them to do. So I think the gates is so powerful from that perspective, right? And it kind of flows right back into this. So I know we're short on time. And it seems like 30 minutes sometimes goes by and as little as 3 minutes. But
Yep.
anyway, so just threw some contact information up there for folks that might have questions after the fact.
Yeah. Yep. Yeah. Thanks for putting that up there. And we did want to make sure that we were respectful of everybody's time, that this was, going to be strictly a half hour. I want to thank you for joining here today, and for the attendees that logged on. And speaking of my dad, I think I turned into my dad. It gets to be a talker, or got to be a talker from time to time. But again, thanks for everyone for attending today. And once again, thank you, William, for putting together the slide content and leading the discussion. And yeah, I do believe that there are no open questions at this point. So do you
Okay.
have any other closing comments for us?
Yeah, no, I mean, again, thanks for being out there on LinkedIn and putting your thoughts out there. I mean, it certainly has been helpful for me to see some of the stuff that you've done. I'm glad that we've created a friendship over the course of the last 6 or 8 months. And like I said, I'm excited to see what you continue to do with this business series as you help, business owners as well as those that are helping them, in other aspects of their lives as well. So kudos for you for getting this kicked off in 2025, and excited to see where it goes.
Well, thank you. And I couldn't have done it without you. And I'm looking forward to seeing how great your 2025 is for you and everyone over at Port as well.
So, Jason's out of curious, you've got the next one potentially on the calendar already. Do you know what date it's going to be, or is it not on the?
Um, I I think it's out on the website, but I don't recall it right now. And in the interest of
Okay.
time,
So check out your website for the next event then, right?
that is right.
Awesome. Okay. Well, thanks again, Jason. I appreciate it.
All right. Thank you, William. Bye-bye, everybody.